Introduction. At Quant Alpha, we investigate the most important asset characteristics, called factors, at the core of every modern investment strategy based on machine learning, a subset of artificial intelligence. Financial strategies once depended on classic parametric models, which can no longer grasp the increasing complexity of modern financial problems. With access to greater computer power, researchers are replacing such legacy methods with modern machine learning-driven techniques such as hierarchical clustering, graph theory, cross-validation, regularization, Monte Carlo simulation, and ensemble estimators, generating robust out-of-the-sample outperformance. In today's increasingly volatile and uncertain global markets, the future will belong to those investors who can leverage such techniques to derive superior strategies. Yet the best use of machine learning technology is not to analyze historical datasets, a common misconception. Such backtesting efforts create a possibly flawed corollary of past performance that never existed, and these unrealistic simulations cannot explain the causal mechanisms that create sustainable gains. Far better is to use machine learning to formulate improved financial theories that help explain market phenomena in terms of causality and can predict black swan events, extremely rare, high-impact, hard-to-predict events. Otherwise, our portfolios remain vulnerable to the increasingly large and sudden drawdowns resulting from radically uncertain left-tail crash events such as the Great Depression, Black Monday, dot-com bubble, financial crisis, and COVID-19 crash. Hence, the best application of machine learning tools is to use them to identify the variables, or factors, involved in complex phenomena, then formulate fact-based hypotheses that connect these factors, which we can subsequently test. At Quant Alpha, we lay the groundwork for building such financial theories using advanced machine learning technology. It allows asset managers, fintech professionals, and private investors to understand the most important factors in financing on which they can build any modern financial theory. We test each factor's validity against 5 research-driven criteria, giving you the building blocks to construct sound financial theories and successful investment strategies. For more advanced readers with a knowledge of Python code and mathematical equations, we subsequently introduce sound machine learning theories about portfolio construction and false strategy detection in the final 2 chapters of our extensive yet easy-to-read ebook. Thereby, our book introduces you to the most dominant factors in trading and advanced machine learning techniques to boost its performance. The factors. FactorBased investing is a strategy where investors choose securities with attributes or factors historically associated with above-market returns. Factors should be broad, persistent drivers of a risky asset's performance on which investors can depend for generating returns, reducing risk, and improving diversification. They include macroeconomic factors, such as the rate of inflation and GDP growth, that can help explain returns across multiple asset classes, including equity and bond markets. And they include style factors, such as momentum, trend, value, quality, and size, which explain returns within different asset classes, such as commodities and equities. From the 600 of factors researchers have identified, we highlight the most impactful: market beta, momentum, trend, value, quality, and size for stocks, and term for bonds. Each can explain the portfolio's returns and have historically delivered above-market, premium returns. Explored in detail in our ebook, each factor also passes evaluation against 5 stringent criteria, proving their validity. These must-factor criteria are persistence, pervasive, robust, affordable, and logical. To elaborate further, we must find that each factor is persistent across multiple regimes and long periods, pervasive across asset classes, sectors, regions, and countries, robust under different definitions and measurements, affordable enough for an investor to realize returns, and have a logical, behavioral, or risk-based explanation for their superior outperformance. The market beta factor. Often confused with volatility, the dispersion of a security's returns, market beta measures how much a security tends to swing compared with the broader market. That is, how risky it is compared with the market. A strategy based on market beta prefers riskier assets because they tend to outperform less risky ones. Mathematically, market beta is the correlation between an asset's returns and the market's returns. multiplied by the asset's volatility divided by the market's volatility. If an asset's beta is greater than 1, that asset is riskier than the market, and vice versa. Bonds have a fixed value or beta of 1. Stocks have a variable beta, so most of the risk of a portfolio comes from stocks, not bonds. If a portfolio comprises 70% stocks and the stock's beta is 1.5, the market beta of the overall portfolio will be 1.05, 1.5 multiplied by 70%. Market beta passes all 5 assessment criteria, with several logical explanations. For example, the risk of owning securities and the macroeconomic risks are correlated. High net worth individuals own a large percentage of equities, and younger people with a higher tolerance for risk prefer equities over bonds. Clearly, then, market beta, risk versus the market, equates to reward. Yet, market beta cannot fully explain the higher average returns of small stocks or the positive relationship between the earning-to-price ratio and average stock return. The value factor. Value investors prefer stocks that are inexpensive relative to their actual or book value because they tend to outperform pricier ones. Value investing is where you buy stocks you think are trading below their actual or book value. We calculate the value factor by subtracting the average annual return of growth stocks from that of value stocks. Value premium is represented as high minus low, HML, which is the spread in returns between stocks with a high book-to-market, BTM, value ratio and stocks with a low BTM ratio. We categorize the top 30% of stocks with the highest BTM ratios as value stocks, the bottom 30% with the lowest BTM ratios as growth stocks, and the middle 40 as core stocks. The value factor passes all 5 assessment criteria, with both risk-based and behavioral logic supporting it. Explained in further detail in our ebook, several findings are worth noting. Value stocks are cheaper because they are riskier, with poor performance, earnings, and profitability versus growth stocks. The value premium increases during recessions and decreases during good economic times. The premium is negatively related to industrial production and money supply, while positively related to interest rates. The value premium also has an important behavioral explanation. A mispricing tendency arising from cognitive biases such as anchoring and loss aversion. Ultimately, growth stocks tend to be overpriced because of misperceptions about their future growth, and value stocks underpriced for the same reason. Beating earnings yield, free cash flow yield, gross profit yield, BTM, and forward earnings estimate, the best metric of a value stock is enterprise yield. Calculate this by dividing earnings before interest and taxes, EBIT, by total enterprise value, TEV, market capitalization plus total debt minus excess cash plus preferred stock plus minority interests. The size factor. Small and mid-cap stocks commonly outperform large-cap stocks, making size an investment factor. Also known as small minus big, SMB, we calculate the factor by subtracting the annual average return of large-cap stocks from the annual average return of small-cap stocks. Stocks with a market capitalization of under $2 billion are small-cap, between $2 billion and $10 billion, mid-cap, and over $10 billion, large-cap. Another definition categorizes stocks within deciles, 6 to 10 of the CRSP index as small-cap stocks, and those within deciles 1 to 5 as large-cap. The size factor is only moderately persistent, less so than market beta, value, and momentum, but this depends on how we define the factor and the companies. It is best used in combination with other factors. Besides that, the factor is pervasive across financial markets and affordable. The size factor has a simple logical explanation. Small-cap stocks are riskier because versus large companies, small ones have a narrower capital base, more leverage, higher volatility of earnings, lesser ability to withstand economic downturns, lower profitability, more restrictive access to capital, less liquidity, more uncertain cash flows, less experienced management, and a new and unproven or less proven business model. Accordingly, small cap stocks are more volatile and vulnerable to poor macroeconomic conditions. An important anomaly exists: small cap growth stocks. These deliver poor growth versus small cap value stocks and are more volatile, earning them the moniker the black hole of investing. Although riskier, they produce lower returns than large cap growth stocks. Behavioral explanations exist for the small cap anomaly, primarily the lottery ticket phenomenon. They provide a small possibility of gaining a huge return, which attracts investors and therefore overpricing, and eventually negative average excess returns. The size factor has faced criticism in recent years, yet it is an important source of alpha when more carefully defined and incorporated effectively within a multi-factor strategy. The momentum factor. Winning stocks tend to continue winning, losing ones to lose, at least in the short term. Buying well-performing stocks and shorting poorly performing ones delivers a significant premium over a 2 to 12-month horizon. We calculate the momentum value by accounting for the last 12 months of returns, excluding the most recent month, as research shows it has a reverting behavior. We subtract the average return of the bottom 30% of stocks from that of the top 30% to determine the momentum factor, referred to as up minus down, UMD. Two different types of momentum exist: cross-sectional and time series. Cross-sectional momentum measures relative performance by comparing the returns of an asset with those of other assets in the same asset class. A strategy might buy the 30% of stocks with the best relative, in class, performance, and short sell the 30% stocks with the worst. The strategy would still short the assets with the lowest returns, even if all assets rose in value. The cross-sectional momentum factor meets all 5 criteria. It is substantiated by the frog in the pan behavioral theory that investors underreact to continuous, small information versus discrete, large information events. This produces mispricing. Importantly, portfolios with shorter holding periods and fewer stocks clearly deliver higher returns. Although myths about the factor pervade, long-only investors cannot capture it, it exists only in small-cap stocks, and it exists predominantly on the short side. No evidence support any of these myths. The key to a successful momentum strategy is not to rebalance mechanically, but invest patiently. Investment managers should reduce the order size and set limit order prices that generate liquidity. Finally, while cross-sectional momentum can deliver the highest returns, it also suffers the worst crashes, having an excess kurtosis of 13%. At Quant Alpha, we create industry-leading risk mitigation strategies using our AI and machine learning technologies to limit the impact of such adverse events. Time series momentum measures an asset's trend against its own performance. Sometimes referred to as trend following, time series momentum depicts the absolute performance and not relative performance. A strategy based on trend following would buy the assets that have been rising in value and short the assets that have been falling. It would short none of the assets if all had risen in value. Like cross-series momentum, the factor is substantiated by the frog in the pan behavioral theory. Trend following satisfies all 5 criteria and produces strong, persistent, and continuous superior returns, especially for small-cap stocks. The quality factor. High-quality stocks outperform low-quality ones over the long term. The difficulty is in defining what quality is. Early researchers considered it synonymous with the profitability factor, defined as sales minus the cost of goods sold and measured by the gross profits to asset ratio. Noting profitability and value strategies mixed and had low volatility. Recently, research has extended the profitability factor into a broader quality factor. We now term stocks that are profitable, growing, and have a high payout ratio as high-quality stocks, which outperform low-quality stocks with the opposite characteristics. This combination passes all 5 criteria, with the premium primarily attributable to behaviorally derived mispricing. Investors are too optimistic about the future performance of low-profitability, low-quality firms. They expect unprofitable firms' performance to mean revert faster than they do and willingly bet on their revival despite their low profitability and poor quality. Bonds and the term factor. So far, we have covered factors defining the profile of an asset pricing model for stocks. A much simpler asset pricing model exists for bonds, with only two factors: duration, term, risk, and credit, default, risk. The default factor, the return on long-term government bonds minus that on long-term investment-grade bonds, is deceptively low. When we account for the higher costs of trading corporate bonds compared with U.S. government bonds, it becomes negligible. We therefore see no need to diversify the default risk and do not recommend it for allocation. However, the term factor passes all five criteria, and importantly, it provides significant diversification benefits because of its historically low to negative correlation with other factors. Following periods of heightened volatility, investors traditionally flee what they perceive to be higher risk investments, stocks, and purchase safer investments, such as bonds. We therefore recommend bonds to hedge against increased volatility and market crashes. Creating a factor-based investment strategy. To build a successful portfolio, the sophisticated investor combines multiple factors to mitigate risk and optimize potential returns. Begin by determining your financial goals to understand your need, willingness, and ability to take risk. Alongside the investment plan, you consider a risk management plan, tax plan, and an estate management plan. Each is key to ensure you take the appropriate amount of risk without overexposing yourself. Modern portfolio theory has two key arguments. First, a portfolio's total risk and return profile is more important than the risk-return profile of any individual investment. And second, proper diversification mitigates the risk of underperformance and reduces the dispersion and volatility of returns without decreasing the expected returns. Investors must also beware of the psychological risk of tracking error regret, which arises when a portfolio underperforms a popular but arbitrary benchmark. To avoid this, judge a strategy's quality ex ante, not ex post. That is, on its prudence given the knowledge available at inception, not at the outcome. Other cognitive biases investors must anticipate are recency, relativism, and impatience, which are explored in great detail in Chapter 7 of our ebook. And further, investors must avoid the allures of actively managed funds with low active shares, i.e., avoid closet indexers. Otherwise, they pay exorbitant charges for essentially non-active passive stock services. Ultimately, Quant Alpha advocates long-term, disciplined investment strategies founded on logical and optimally diversified factors. As the second part of this book explains, this entails a portfolio with downside protection that employs hierarchical risk parity, HRP, nested clustered optimization, NCO, and avoids overfitting by using SIDAX correction to get the family-wise error rate, FWER. A buy and hold strategy mostly outperforms active management, but it can lead to huge intermediary losses of over 50%. Such losses typically result from black swan events. For example, the Great Depression crash of 1929, Black Monday 1987, dot-com bubble 2000, GFC 2008, and COVID-19 2020. An optimized, systematic strategy can reduce this risk, achieving two objectives: to maximize profits during bull markets and to exit ahead of bear markets. We present a downside protection method based on the volatility of the momentum factor. We have selected a momentum portfolio for risk mitigation because momentum has experienced the worst crashes of all factors throughout history. Therefore, controlling the momentum risk can prove a viable downside protection strategy for the overall portfolio. This is the risk weighting approach. As the volatility rises, the share invested in a risky asset is reduced in favor of a low-risk asset, such as long-term treasury bills. When volatility drops, vice versa. This approach requires setting two parameters: the look-back period for calculating volatility and the volatility threshold at which you weigh between equities and bonds. We also optimize for the Sharpe ratio, the risk-adjusted return. This strategy beats the market because it has lower risks and reduced drawdowns. Being rule-based, it also helps avoid the psychological risks to which investors often fall prey. We also add a trend-following signal for the risk weighting because staying invested in the stock market when it is trading above its moving average, MA, and positioning defensively when it is below the MA considerably improves risk-adjusted performance with smaller drawdowns. We offer our complete calculations in our ebook, but note here that it performs exceptionally. The maximum drawdown is less than half of that of a buy-and-hold S&P 500 strategy. Portfolio construction using machine learning. Modern portfolio theory, MPT, represents portfolio construction as a solvable optimization problem. It estimates an efficient frontier of optimal portfolios. These portfolios maximize the expected return given a defined risk, the standard deviation, or annual returns. MPT's first iteration was inherently unstable due to information noise in the covariance matrix, and it only works in ideal conditions, where securities are uncorrelated, unavailable in real-world finance. While many researchers have attempted to reduce this instability, we find the machine learning-based algorithms such as hierarchical risk parity, HRP, and nested clustered optimization, NCO, methods most effective, achieving superior performance out of sample. Hierarchical risk parity, HRP, is a risk-based portfolio optimization algorithm. It applies modern graph theory and machine learning techniques and has been shown to generate diversified portfolios with robust out-of-sample outperformance without the need for a positive definite return covariance matrix. This machine learning algorithm operates in 3 stages: tree clustering, quasi-diagonalization, and recursive bisection. The resulting allocation is both well-diversified over risk sources and intuitively appealing. The nested clustered optimization, NCO, algorithm can reduce the instability by separating the problem into several steps. It begins by clustering the given correlation matrix using the optimal number of clusters. Then, we compute one optimization per cluster, intra-cluster, before computing a final optimization solution between all clusters, intercluster. As each security is part of one cluster, the final allocation weights result from the multiplication of the intracluster and the intercluster weights. Our full ebook offers comprehensive Python code to implement this process and account for several other factors. Testing set overfitting. We can use randomized draws, called a Monte Carlo simulation, to evaluate the performance of machine learning portfolio construction methods. This allows for controlled settings by which we can obtain conclusion on mathematical and statistical properties with greater accuracy than by observing real-world performances. This is crucial for reaching causal inference conclusions. In a typical financial investment strategy development, researchers do not use randomized draws. Instead, they run many trials against historical time series, backtesting. This exposes researchers to serial correlation, multicollinearity, and often non-stationarity issues, and risks them overfitting strategies because they perform several historical simulations and dispose of those less successful. This overfitting is also called the selection bias under multiple testing, SBUMT, and leads to delusive claims because it inflates a strategy's performance. 2 methods exist for evaluating overfit. First is the false strategy theorem, which derives an expected value for the maximum Sharpe ratio, SR, as a function of the number of trials, K, and the variance of the SR across trials. The discussed NCO algorithm allows us to estimate the variables. With the resulting SR estimate, we can test if the maximum SR is statistically significant by using the deflated SR. A second method is to estimate the number of trials K and use syntax correction to get the family-wise error rate, FWER. The FWER gives an updated rejection threshold for a statistical test, allowing us to test whether the reported maximum SR is significant. We can use the analytical estimate of the family-wise false positive and negative rates when designing statistical testing frameworks. Our ebook elaborates this process in complete detail. Conclusion. Today's investment landscape is fraught with uncertainty and volatility. Financial technology, Combative geopolitics and globalizing industries are inextricably intertwining our economies and making them hyper-reactive to disruption. And massive left-tail events, pandemics, financial crashes, cyber attacks, political upheavals, and climate change create unpredictable perils. Yet it is also a landscape of newfound opportunity. With larger datasets, more powerful computers, and smarter algorithms, we can escape from flawed history-based forecasting and formulate better financial theories that can predict black swan events and intelligently optimize portfolios in real time. The machine learning revolution is unlocking industry-reshaping techniques, hierarchical risk parity, deep learning regression, k-fold cross-validation, SIDAX correction, and many others. By incorporating these into factor-based strategies, an investor can capitalize on an economic environment with an untapped capacity of billions of dollars. In a landscape where marginal gains create exponential growth, by teaching you these techniques, Quant Alpha has given you the building blocks to outperform the market and consistently generate alpha. Yet this is only a glimpse of the inside knowledge that Quant Alpha uses to create downside protection, higher and more consistent returns, and optimized portfolios. Our algorithmically driven research runs much deeper. We have built our entire company around exploring the full potential of machine learning and factor-based investment, processing millions of datasets across multiple sectors and international markets to recognize patterns and predict trends. We offer all our machine learning-backed research results. You can apply our optimized portfolio strategies directly to your own investments. In a world where marginal gains create exponential growth, Quant Alpha gives you the AI edge to outperform the market. We highly recommend reading the original full version of our ebook to learn and discover more about our technology. And to benefit directly from this enhanced process, explore our platform.